Welcome to The Swing, the official newsletter of the Forex Trade Room, Volume 6, February 9th, 2024. The dollar index saw a slight decline, dropping below 104.1, following the revision of U.S. CPI data for December, which showed a smaller increase than initially reported. This adjustment strengthens the case for disinflation and supports the Federal Reserve's inclination towards reducing interest rates in the coming year. As a result, the market's expectations for a rate cut have adjusted, with a slight uptick in the probabilities for March and May. Despite the dip, the dollar index managed to notch a slight gain this week, its fourth in a row. The Australian dollar is near a 12-week low at 65 cents as the Reserve Bank of Australia keeps options open on future rate movements. While the RBA's Governor Michelle Bullock indicates rate cuts could occur without inflation reaching precisely 2.5%, further rate hikes have not been discounted due to ongoing inflation concerns. Despite holding rates steady recently, the RBA admits inflation's easing yet remains cautious about its return to the target range. Analysts from CBA predict rate reductions both this year and the next, reflecting the complex economic landscape. The Canadian dollar strengthened this past week, showing resilience as it climbed from a two-month low, bolstered by an encouraging labor report. January's job additions and reduced unemployment have invigorated the economy, allowing the Bank of Canada to consider maintaining its tight monetary policy aimed at controlling inflation. This development counters worries about the impact of sustained high interest rates on growth, highlighting the underlying strength of Canada's labor market. The yen continues to weaken as BOJ Deputy Governor Uchida tempers expectations of a quick change in Japan's monetary policy, assuring a cautious approach to interest rate decisions. Despite the improving likelihood of hitting the 2% inflation target, the central bank emphasizes the importance of steady market operations. With December's inflation exceeding the target, the yen's decline reflects market reactions to the BOJ's stance. The New Zealand dollar sees an uplift, touching a week's peak due to bets on further rate increases by the RBNZ amidst persistent inflation and a strong job market. Market odds favor a rate hike at the end of February, reflecting global central bank trends against premature rate cuts. However, a robust US dollar continues to apply pressure. The Swiss franc has dipped to a near two-month low against the US dollar, influenced by the dollar's strength and anticipation of a delayed Fed rate cut until May. Despite rising inflation expectations from the SNB due to domestic factors, inflation remains below the 2% target. The SNB continues to support the franc through foreign exchange interventions, with reserves hitting a 7-year low. The British pound recovered slightly after hitting a 7-week low, currently at $1.26, amid tempered expectations for quick interest rate cuts in the UK and US. Bank of England officials signaled a cautious approach, indicating that while rate reductions are considered, they are not on the immediate horizon. Despite this, the UK housing market remains robust, reflecting ongoing economic resilience. The euro maintained its ground, floating around $1.07 as ECB policymakers urge caution on rate cuts, pushing market expectations for easing back. While the chance of an April rate cut dwindles, some officials even question if cuts will occur this year. Meanwhile, in the US, healthy jobless claims bolster the dollar, signaling a deliberate Fed stance on policy changes. The Mexican peso has seen a slight retreat from recent highs as Banxico holds its key interest rate unchanged at 11.25%, marking the seventh consistent decision. January's inflation ticked up to 4.88%, prompting the central bank to maintain a cautious approach. With long-term inflation expectations on the rise, Banxico underscores its readiness to adapt its monetary policy to ensure steady progress toward the 3% inflation goal. This week, WTI crude oil prices saw a notable jump, closing at $76.84 per barrel, fueled by escalating Middle East tensions, including Israel's airstrikes in Gaza and a U.S. drone strike in Baghdad. These developments, coupled with significant changes in U.S. oil and gasoline inventories, have kept the oil market on edge. In the gold market, prices nudged down to just below $2,030, as recent U.S. economic data and central bank comments led investors to rethink future monetary policies. The slight revision of U.S. inflation rates for December suggests a gradual cooling off, yet Fed officials remain wary of cutting rates too soon. Across the pond, cautious tones from ECB representatives further dampen hopes for rate cuts this year. This week in the US stock market, we witnessed a mixed bag as the S&P 500 and Nasdaq soared to new highs, propelled by major tech companies, while the Dow faced a slight dip due to underperforming sectors. The latest CPI figures from December confirmed ongoing disinflation, posing no shocks to market forecasts. Despite some earnings letdowns from companies like PepsiCo and Expedia, the overall market trend remains robust, with the S&P 500 marking its most consistent gains in over 50 years. This week, the financial spotlight is on the US with a series of critical economic reports including inflation data, retail sales, and the Michigan Consumer Confidence Index, alongside speeches from Federal Reserve officials. The earnings season forges ahead with major companies like Coca-Cola and Airbnb set to reveal their financial performances. Globally, significant releases such as the UK's GDP and unemployment data, along with other international GDP growth rates and inflation figures, will keep markets on their toes. Key sentiment indicators from Germany and Australia will also offer insights into economic conditions. Remember, don't count the days, make the days count. That's all for this week's edition of The Swing. Let's make it a great week, everybody. Bye for now.